All right, let's talk about one of the biggest decisions you'll ever make in your retirement planning. It's not about how much you save, but how you'll actually get paid from your annuity. This choice, right here, it can shape everything.
You spent years, maybe decades, focusing on one thing, building up that nest egg. But once you hit retirement, the game completely changes. The real question isn't how much you have, but how you're going to turn that lump sum into a paycheck that lasts as long as you do.
So, I want you to picture yourself standing at a fork in the road. This is it. This is your retirement journey, and you've got two main paths in front of you. Each one leads to a very, very different destination.
And what are those two paths? Well, they're called annuitization and lifetime withdrawals. Now, on the surface, they might sound similar. They both can give you income for life, but believe me, they work in fundamentally different ways. So let's break them down, and you can start to see which one might be the right fit for you.
Okay, so let's walk down this first path together, annuitization. This is, you could say, the classic, the traditional way to get an income stream in retirement. It's been around for a long time. So what does annuitization actually mean? Well, think of it as a permanent trade. You hand over your entire account value, the whole lump sum, to the insurance company. And in return, they promise to send you a paycheck for a set amount of time, often for the rest of your life. Now, the most important word on this slide, the one you absolutely have to remember, is irrevocable. Once you do this, there's no turning back. You can't call them up and ask for your lump sum back. It's gone. But the upside is huge. You get total simplicity, a paycheck you can count on, and you've basically handed off the risk of outliving your money to the insurance company. That's their problem now, not yours. Here's a really easy way to think about it. Annuitization, it's like trading in your car for a guaranteed lifelong bus pass. You are set for life when it comes to transportation. You'll always have a ride. But you don't own that car anymore. You can't just decide to sell it one day if you need a chunk of cash. All right, so that was path one. Now let's back up to that fork in the road and check out the second option, lifetime withdrawals. This is a much more modern approach, and it's all about keeping your flexibility and control. So this option usually comes from something called an income rider. Just think of it like an optional feature you add to your annuity contract. Instead of trading in your entire account, you're just taking guaranteed withdrawals from it. And the key difference here is that you still own the original account. It's still yours. With this route, you hang on to your account value, which is so important if a big emergency pops up. But here's the really powerful part. That income is still guaranteed for life. Even if the market takes a dive and your account value goes all the way to zero, the insurance company is still on the hook to pay you. See? This whole structure is about keeping your options open. So, to go back to our car analogy, this path is like keeping your car but hiring a chauffeur on a lifetime contract. You still own that valuable asset, the car, and you can get to it if you need it, but you also have that guaranteed ride, that service, whenever you want it. Okay, so now you've seen the two paths. Let's really put them under the microscope. Let's put them head to head on the things that are going to matter most to you in retirement. First up, let's talk control and flexibility. With annuitization, your control is, well, pretty low. That decision is permanent. It's set in stone. But with lifetime withdrawals, your control is high. You still own the asset, and you have the flexibility that comes with that ownership. And that leads us straight to the next point, access to your money. And honestly, this is a huge one. With annuitation, you have zero access to your principal. It's locked away. With lifetime withdrawals, you can usually get to your remaining account value if you need it, for a new roof or a medical bill, though of course there are contract rules. And what about leaving money behind for your loved ones? With a basic annuitization, those payments could just stop when you pass away. But with lifetime withdrawals, whatever money is left in your account, that can typically go right to your beneficiaries. For a lot of people, that makes all the difference in the world. When you see it all laid out like this, the core trade-off becomes crystal clear, doesn't it? On the one hand, annuitization gives you ultimate simplicity. You set it and you forget it. On the other hand, lifetime withdrawals give you ultimate flexibility, keeping you in the driver's seat. It's a fundamental choice between simplicity and control. So here's the most important thing to understand. This isn't about which path is better in some objective way. No, it's about which path is better for you, for your life, and for your goals. The source material just puts it perfectly here. The right answer is a deeply personal one. It all boils down to what you prioritize, what helps you sleep at night. So this really brings us to the central question you have to ask yourself. What do you crave more? Is it the absolute hands-off simplicity and potentially a higher regular paycheck that comes from an irreversible decision?
Or do you value keeping control, having that flexibility for whatever life throws at you, and having the option to leave a legacy? So, as we finish up, I'm just going to leave you with this one question to think about for your own plan. What really, truly matters more for your peace of mind? Is it the beautiful predictability of absolute simplicity? Or is it the power and the options that come with ultimate flexibility? The answer to that question is going to point you down your path.